In this video, I'm going to again tackle two questions. So the first question is going to be question number 9 about financial planning. In particular, here we're going to be looking at how the entrepreneur, the business owner, um, puts capital into its own business and how that affects the business. And in question number 10, we're going to be looking at the difference between stocks that pay dividends versus reinvest dividends and how that affects returns for us as shareholders. Okay, so let's start with the entrepreneur. So here, the most important thing to understand is essentially how the balance sheet the balance sheet of the business looks like. Okay, so once again, on the left-hand side, we have assets. And on the right-hand side, we have owners or investors or capital invested in these assets, owners of those assets. And this could be divided into liabilities. So once again, liabilities could be financial, non-financial. So whoever lended money, whoever we owe money to as a business. And the other account is equity. So these are the two, essentially, the two sides and the balance sheet balances, meaning that all the assets belong to either lenders in some form, so liabilities, or the owner's equity. Okay. Within assets, we have a sub-account over here that is called financial assets, and cash would be one of those sub-accounts. We also have short-term investments and alike. Okay, within equity, we have paid-in capital. Again, one of the sub-accounts. Okay. So all of this is on the kind of based on the accounting data, so backwards looking historical transaction data. Okay, so please don't confuse that with market valuation of equity, like market capitalization, which is market forward looking value of equity. So this is essentially a kind of history of transactions that company went through, while market capitalization essentially measures how much future profits the company is expected to get. So they're like complementary, but actually describing quite different things. So in this particular case, what we are looking at is the historical transaction that happened. What did the entrepreneur do? The entrepreneur put money from his pocket into the pocket of the company. So how are we going to record this transaction? So first of all, the cash that this company has is going to go up, okay, as well as paid in capital. Okay, so the amount of money that Riley paid into the company, paid in capital, has increased. So the share, the amount of money that he has a stake on in the business has increased at the same time as the assets have increased in exactly the same amount. So 20,000, and we have increase in capital. So here the implied equity capital and increase in assets. Sorry, I didn't mean to point at B. I rather meant to point at increase in capital, increase in assets. So the company became bigger by $20,000 in the accounting valuation. Okay. So let's talk about question number 10 now, which is looking at investments in shares. So this is again, this we are looking now, kind of shifting gears from looking at the company and investments in terms of like accounting valuation of those, switching gears and looking at the financial market valuation. So here the value of the share is not going to be how much money the owners put in, but rather the value of the future profits. Okay, so that's market value of the shares. Okay, now we're comparing two companies that are exactly identical in all except how they treat, what do they do with the profits. Okay, and so this is again a very stylized example to highlight what are the implication of dividend payouts for shareholders. Okay, so the companies are all identical except the fact that one company pays out profits as dividends, okay, and the other company reinvests those profits and its value is growing at exactly the same rate, so 10% per year. Okay, So if you're an owner of a shares that doesn't pay dividends, and there are a ton of examples of very profitable companies that don't pay dividends and using US stock markets. Amazon is my favorite example when I teach this to students. The fact that company doesn't pay dividends does not mean it's a bad investment. On the contrary, when you use in US data, the companies that do not pay dividends deliver higher total returns to shareholders through the appreciation of the prices than those companies that do pay dividends. Again, this is using US data that might not hold all over the world, but in the US financial markets, companies that do not pay dividends, rather reinvest their profits, are actually delivering more to their shareholders than otherwise. Okay, so that's not a bad thing that the company does not pay dividends. Shareholders still increase their wealth through the increase in prices, which is called capital gains. Okay, so from period to period, what happens with our wealth as a shareholder? Our price of the company keeps going up, and the sequence of prices, this is your capital gains, it's increasing, and that's increasing at 10% per year. Okay. Now, if you investing in a company that pays dividends, classical examples that I like to talk about, companies that have a lot of dividend yield, pay a lot of dividends relative to their share prices. This is typically rights, so they have a mandate. So a real estate investment trust, for example, they have a mandate to pay out more than 90% of their profits, or at least 90% of their profits, as dividends to enjoy their tax advantage status. So anyways, those companies pay a lot of dividends each year. Okay. Now, to receive the same return of 10% per year, the shareholders of those companies need to actively reinvest dividend. Let me explain to you the following. So when you buy a share of a company on your brokerage account, that goes into a depot account. You also have a cash account in your brokerage account, okay? So a share sits over here, and when the dividend is paid, automatically that dividend goes into your cash account. Most brokerages do not pay any return on their cash accounts. Some pay a little bit, like maybe saving account rates. But essentially, all the money that ends up here in the future is not going to make you more money unless you do something with it. And so the question here was asking about what do you need to do to make sure that the dividends that end up in this account, in the cash account, stay working and producing kind of returns, keep capitalizing. Okay, so what you need to do, you need to kick those dividends back into depot, which is reinvesting the dividends. Okay, so the correct answer was C. Will deliver the same return if reinvest the dividends into one of those companies. Once again, both of them delivering 10% per year, so it doesn't really matter which company you reinvest the dividends into, but you have to you have to opt to reinvest the dividends. And that's, I think, a very important message of this question, that if you do invest in assets that pay dividends, you're gonna get market returns unless you reinvest those dividends. Okay.